All right, folks, part 4. So now we have all these adjusted accounts, right? So we have all these adjusted accounts. Turn this on, put the highlighter on. So notice here, there's our adjusted balance in cash, our adjusted balance in accounts receivable, supplies, everything. And remember, all of these, they're all adjusted now, and we got to do an adjusted trial balance where all of our debits equal all of our credits, okay? So a couple things. Adjusting journal entries never involve cash, okay? Never involve cash. And each one includes one balance sheet item and one income statement account. One balance sheet account and one income statement account. No matter what happens, that will always be true. So if you've got 2 income statement accounts or 2 balance sheet accounts, you're making a mistake, okay? Always got to be 1 and 1. Okay? All right, so here you go. Question number 7 from chapter 4. Adjusting entries involve accounts on. We just talked about it. Accounts on. What financial statements would those accounts be on? Make sure you write down your answer so you could do it on the quiz that you'll see on Canvas. All right, now we're going to prepare that adjusted trial balance. Okay, so now we have all those adjustments made. Now we're going to do a trial balance. Okay, so here's Noodle Cake Inc., right? Name of the company, adjusted trial balance at the certain date, right? And here they're showing you partial listing. So remember, we had an unadjusted account receivable of 500. We added 3,250. So now we have 3,750, and that matches this, right? And over here, deferred revenue, we had 300. Then we collected 100. Now deferred revenue is 200. That's this right here. And remember, right here, these guys right here, this is all balance sheet. This is all income statement accounts. So notice revenue, revenue, expense, 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 expense. Over here, asset, 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 contra asset, asset, contra asset, asset. And then over here, these are all assets. These are liabilities down to right here. Then you got liabilities, and then this is stockholder equity. Okay? Right, now that we've done that, we're going to prepare the financial statement. So notice here, on that trial balance, this is going to go over here. Notice we had these two totaled up, $15,350. All of these expenses right here, all of these guys are all coming over here, right? And we're going to show net income here of 14,000. Total expenses 14,555. So their net income is 800 bucks. Okay. And notice what winds up happening. So Noodle Cake, statement of retained earnings, right? For the month ended. Now this is obviously their first month. They started with 0. Add net income of 800. They did not pay any dividends. So now we have retained earnings of 800. And this goes over to the balance sheet. Okay, this goes over to the balance sheet. By the way, let's put this down over here. So here's all of our assets up here. All of those depreciate. By the way, there's the let me get this on. There's the depreciation we did. There's the $400 depreciation. There's the $250 one, right? So our total assets are here. Total liabilities are here. There's our common stock of $10,000 when we first started. There's our new $800 in retained earnings. Notice total liabilities and stockholders' equity, $43,950, $43,950. We balance. That's the key. So now we have financial statements. You see how one runs into the other? Again, remember up here, Noodle Cake, balance sheet. So the name of the company, the name of the financial statement, the date. In this case, it's a point in time. Remember, the other ones are all for a period of time. Okay? All right. Now we're going to talk about something called the closing process. Okay? And what you have to do is you have to bring all of the income statement balances go to 0. Let me just explain. Let's say, for argument's sake, let's say it's July. and you have revenue and expenses for July, right? And now the end of July comes, and you're starting August. What you want to do is you want all those July accounts to go back to zero, so that in August you could start keeping records all over again. And what happens is how you close them is it closes to the retained earnings. You know how we showed net income come down and then close to retained earnings? That's exactly what happens. So each period you do that. So the question is, how do you do it? And that's what we're going to go over. Okay? So you have to, let me put this over here. You have to transfer net income. You have to transfer net income or loss and dividends to retained earnings. And then establish zero balances in all income statement and dividend accounts. Okay? So we're going to show you the process by which you do that. Okay? So basically the income statement. Okay? Let me put that. The income statement is all temporary accounts. Which means they get zeroed out. So notice revenues, expenses, dividends, all get closed out. Okay? All right? And again, they track financial for a limited period of time. Limited like 1 month, 1 quarter. And then this gets transferred to the permanent accounts that track it forever. And the permanent accounts, look here, never close. Those are assets, liabilities, and equity. Okay? So, anything on the balance sheet never closes. Everything on the income statement definitely closes. Okay? So how you do it, there's two journal entries are needed. Okay? 2 journal entries are needed. You debit all revenue accounts and credit all expense accounts. And the reason why, when you debit a revenue account, remember a revenue account increases with a credit. So you're debiting it to bring it to zero, right? And then the same thing, we're crediting expense accounts. Those normally increase with a debit. So what you do is the difference goes to retained earnings, okay? And the same thing with dividends. So it'll look like this. Okay, so here's the closing entry. So this is where we are now. This is our adjusted trial balance, right here. Okay, so look what we're doing. We're going over here, and we have a credit here, credit of 12,100. We're going to debit 12,100. Notice it's negative to the revenue, but look what happens. Then sales revenue, the same thing. Look what we're doing to all the expenses. All of these guys, those were all debits. Look how they were all debits right here. All of these were debits. We're going to credit them. And then the difference between these two, this $800, goes to retained earnings. By the way, that's the exact difference here. It goes, so basically this $800 is going from the income statement and it's going now to the retained earnings. So the money we made is actually going to the retained earnings. Okay? So notice, retained earnings, right? And then if there were dividends, which we don't have here, that's how it would happen on dividends, okay? So there you go. So notice here, after posting all these, the income statements accounts will have zero balance. So here, look at sales revenue, okay? So sales revenue had a $12,100 balance, this guy right here. We credit it, right? And notice here, CJE, this is a closing journal entry, closing journal entry 1. We're closing this out, so now the closed balance is zero. So that way the next month we could start all over, okay? The next one, advertising expense. It had $500. Remember, it was a debit of 500. Here you go, here's the $500. We're gonna credit that, and now it's zero. So that way when the next month starts, everything is at zero, okay? Not too bad, right? All right, now after you've closed everything out, notice all of the accounts, all this income statement stuff right here, notice they all have zero balance. See? 0, 0, 0, 0, 0. And this is after the closing. Okay? And again, remember, contains balances only for the permanent accounts. All right? That's the last step. So now all of this goes to 0, and we start back over. In this case, we're going from September. You'd start over again for October. All right, folks. Part 4. We'll be back with part 5.